Evaluating ICICI Bank today presents a specific analytical tension. To gauge its true trajectory, you have to look past the top-line profit figures and probe for hidden structural risks. Historically, ICICI has featured prominently in academic forensic accounting studies, frequently cited alongside India's most high-profile corporate governance failures. This chart tracks ICICI's share price from mid-2024 through April 2026. The sustained upward trend is the market's response to the bank's Q4 FY26 reality, a staggering 54,207 crore rupee consolidated net profit. That level of profitability is driving a renewed market premium. But before projecting future gains, we have to rigorously stress test the structural integrity of the balance sheet that produced it. The thesis we need to test is straightforward. With an aggressively expanding operational moat, is ICICI Bank's balance sheet clean enough to deliver a 3x return over the next 5 years? Or is the stock already priced for absolute perfection? The foundation of ICICI's moat is its liability generation. In the first quarter alone, the bank added 83 new branches, pushing its total physical distribution network past 7,000 locations. By integrating that massive physical footprint with the iMobile app and the iCRM unified platform, ICICI has re-engineered how it acquires deposits. This chart shows the composition of deposits. Retail and small business deposits, known as RSBD, now fill 61% of total volume, up from 57% in FY24. In stark contrast, the top 20 wholesale depositors account for a microscopic 4.2%. That 4.2% metric provides critical risk mitigation. A highly fragmented deposit base with incredibly low concentration limits the threat of a sudden institutional bank run. At the same time, the bank has aggressively simplified its tech stack, reducing its product variance from 1,000 down to exactly 600. ICICI's liability generation operates as a tech-driven monopoly on consumer trust. It provides an unshakable, granular foundation of cheap capital. Pivoting to the asset side of the balance sheet, ICICI deployed that capital to drive a 15.8% year-over-year growth in total advances. This dual bar chart isolates the specific driver of that advance rate. While standard retail loans grew at a moderate 6.9%, the high-yield business banking, or MSME segment, saw a massive 24.4% surge. Simultaneously, the bank executed a 5.6% contraction in its unsecured credit card book. This is a proactive risk control mechanism, preventing overleveraging in volatile consumer segments. The MSME portfolio carries a built-in structural advantage. 70% of these loans have ticket sizes under 0.1 billion, guaranteeing massive asset granularity and a shorter overall duration. This disciplined asset deployment yields pristine asset quality metrics. Gross NPAs have fallen to 1.40%, net NPAs down to microscopic 0.33%. The provisioning coverage ratio exceeds 75%. This metric divides the price-to-earnings ratio by the expected growth rate, revealing whether a stock's current price is justified by its future earnings trajectory. This scatter plot maps the sector's valuation. Look at the horizontal axis. ICICI's PEG ratio sits at a massive 3.95, completely isolated from HDFC's highly efficient 1.49. That elevated PEG ratio signals that the market is paying a heavy premium today, while pricing in a highly cautious outlook for future earnings acceleration. This chart tracks the loan-to-deposit ratios across the sector. You can see the operational ceiling driving that cautious outlook. ICICI exhibits a sharp, continuous downward trajectory, pulling away from its peers and heading towards 60. It strictly penalizes any expectation of undervalued hypergrowth. If we project this trajectory through the FY28 estimates, ICICI's net interest income is expected to easily cross 1.14 trillion INR. The core adjusted book value per share will follow suit, expanding to 564.6 over the same period. This curve plots EPS scaling to 90.2 by FY28, juxtaposed against the trajectory required for a 3x return. The math is unforgiving. A 24.5% annualized growth rate is impossible without massive multiple expansion, currently blocked by the 3.95 PEG ratio. Based on the data, the portfolio recommendation is clear. Hold if you are running an aggressive growth strategy, but accumulate for core defensive stability. ICICI Bank has successfully buried its historical forensic shadows beneath an impenetrable digital moat and pristine asset quality. It has transformed into the sector's safest compounder, even if it is no longer priced to be its fastest rocket.